But you are right, Eric. Americans have Stockholm syndrome with insurance companies. They love their abuser and they just they don't understand what the new is. So we will lease a carrier. We can use United, Blue Cross, Cigna. We've got some permission with Aetna on certain size clients where we could use their Coliseum. We could use their network. However, we have the right to go in and say, no, 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 no. Even though this doctor's a PPO doc, I wouldn't even send a goldfish to him. Or you don't want to go to Dr. Hack him up. He's got really bad ratings. So we could make sure that the employees see the brand, they're comfortable. HR cares about two things, people and process. CFO looks at P&L. So we can reduce the cost, but give the member a really great experience, just like you're describing.
Welcome to Insurance Shoptalk. This is the podcast where the world of commercial insurance gets a little closer to home. I'm your host, Eric Stein, and in every episode, we're taking a deep dive into the insurance industry. From the latest news and trends to in-depth interviews with InsurTech experts, carriers, and agency newsmakers, we're covering it all. So sit back, tune in, and let's start the conversation. All right, guys, today we've got Dan Thompson, Chief Benefits Officer with Venture Employer Services. Venture is a private equity-backed firm that is a huge organization. And I wanted Dan to come on because in the P&C world, we as agents, half of us kind of hate the healthcare arena, and the other half, understand it and can do both the P&C and medical. And some of us just refer to folks in our shops, to handle the healthcare as an afterthought, once we get the P&C done. But you guys are going to flip out of your chair when you hear what Dan's done, and I'm part of it now in terms of the coverage. So I've gotten to seen it live. It's a new modernization, if you will, of health insurance. So I don't want to steal too much of Dan's thunder, but I want to tee this up that this is not some boring medical insurance presentation. This is a game-changing program for large clients. So any client, and I'll let Dan speak to the numbers, but your larger clients, and this is not talking about Blue Cross, Blue Shield, or United. I mean, it can do some of these things, but this is not the intent. But Dan, why don't you kind of introduce yourself and your background, and then we'll start getting into it.
Yeah, no problem. Appreciate you having me on the Insurance Shop Talk podcast. Very cool. I've appreciated working with you, and you and I share a very similar role, which is division presidents within this crazy rocket fuel nuclear growth venture. As you said, it's almost 100 PEOs, maybe 50 payroll bureaus and HCM companies. And then obviously now we're also in the care management business too, right? We have doctors and nurses. But just to give you a brief background for those that don't know me that are listening to the podcast, I actually came from the P&C world. I'm still a P&C licensed broker. I worked for a small agency after years with Paychex and ADP. So I know the payroll world really close in and out. Came into a P&C firm and started growing their benefits shop. It was very small, but I was a dually licensed agent, still am today, health, life, and P&C. I don't do any P&C at all. That's why we have Eric and our teams across Venture. But I've solely focused on benefits. So, in those days, 25 years ago, I was selling what we call the BUCA plans, right? The Blue Cross, United, Cigna, Aetna, and we were doing the typical, what I call the kabuki dance, which is bringing the client a 20+% increase and then bullshitting them and telling them, because we have to water the plans down with high deductibles and high copays, that we would take their 25% increase and get it to a 6 or an 8, right? And that happens even still today. Unfortunately, a lot of C-suite people, CFOs, CHROs, CEOs of companies, they don't know that there are other options out there. So, fast forward, I had gotten out of that P&C firm and actually sold to Acrisure. Then I started my own firm, which specialized only in employee benefits. And then 3 years into that, we doubled the size of the book. It was more than what it was when I was in the P&C firm. And then sold most of that firm initially to create Thompson Risk 2, which is what we have today. And we run that inside of Venture and doing the employee benefits. So we're the BOR and handle 15 master plans. And somewhere around I don't know, maybe about 1,000, maybe 1,100 open market clients. And our whole ecosystem today is about 270,000 people covered on major medical, which is pretty insane. We have 107 carriers, and we do a lot of self-funded and what we call max funded. So, we support the PEOs. If you have a client that comes over to us, you could not only in our world have a master plan potentially with that client, which is the pretty standard traditional PEO offering, but we also do and can do an open market plan with the PEO and still pay the co-broker split even on that insurance in addition to the PEO admin. So a lot of co-brokers, I fly to New York tonight to meet with about a dozen in the Long Island to talk to them tomorrow about how these unique plan designs work and how we're creating new plan designs. So I know, Eric, we wanted to talk a little bit about how that's working even for our own employees.
Yeah, absolutely. And then, again, I think the reason that we as P&C agents don't like to get into the healthcare piece is what you just described, that terrible experience of the renewal.
Yeah,
Typically in workers' comp, especially in the softer market, you're not handing out those kind of increases the only thing that's hurting now typically is the personal lines on the property and then the commercial auto, right? So those are nasty places to be, but the commission's really high, so it's you can live with it. Uh, but anyway, so we shy away from it because we don't want it to like upset the client so much at renewal time on the health insurance that they want to leave us as on the commercial side, and plus we don't like dealing with the minutia of it as well in terms of all the daily problems. Even if we have a CSR account manager, when the owner can't get in to get the owner's wife can't get their prescription filled or some problem there with issues of coverage, the the owner starts blaming me, right, as the
yeah,
agent or our agents. So what I love about what you're doing from an experience perspective is that you got things set to deal with larger clients, so we don't have to deal with your 20-man client here. And B, you are improving the hell out of the experience of the benefits so that, it really cuts down on the blowback. So I want to, again, I don't want to steal thunder, man, 'cause you know how much I love what we've got with this
yeah,
AIM program and buying AIM. I want to make sure we talk about that and how you layer that nurse case management pieces in. But
yeah,
yeah, talk about the modernism, the new modern approach, the size of the clients you typically would want to target with
yeah.
this and what it is.
Yeah. So our clients range from the gamut of as low as 5 employees to on up over 35,000 employees. So obviously I would love to go to one of those broker conferences, and a lot of them, a lot of people lie and say they have a bigger boat than they actually do. That's just the way the freaking world is. But the reality is we're in PEO, right? PEO is an average of maybe 26 employees. So we have hundreds upon hundreds of clients like that, and maybe about 25% or so are above 500, which is a pretty respectable size book. I would say maybe about 40,000 total lives or so in self-funded plans in our orbit, which is a lot. And what we found was the traditional way of self-funding was the same way that self-funding was designed in the 1960s, right? It
Hey,
just
Dan, sorry to interrupt you. I want to make sure we clarify that what we're speaking about today is not having to even, if necessarily use a PEO to get
right.
this. Like this is a standalone product that an agent can use for their larger clients, and they're having some
Yes.
scenarios in healthcare that you want to mitigate, and they can bring us in, you in, and come up with a phenomenal program you're about to describe without it being part of co-employment, or if it fits
Right.
co-employment or any other models that we offer in
Yeah.
pay, whatever, or not. So go ahead. Sorry.
I no no I agree with you. I think most large employers are not doing co-employment. So,
It's too
you know,
big. Yeah.
over 100 employees, we could do this program I'm about to kind of talk about at 50 or more enrolled, right? So years ago, going back many years, it occurred to me that there needed to be more control of the variables in the healthcare spend. And the amount of corruption, or you could call it fraud, waste, and abuse in the healthcare system is actually intentional, because when the ACA law was passed March 23rd, 2010, it regulated the amount of margin that the health insurance companies can get, right? So if you think about that, the MLR law, or the loss ratio law, says that as long as for every dollar the carrier spends, the every dollar the carrier gets in premium, they have to spend 85 cents in medical and prescription drugs. And if they spend more than 85 cents, they have to rebate back. But they can keep no more than about a 15% margin. That's the law. So what those carriers did is they went back to their boardrooms and said, wait, 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 wait. So if our margin is 15% of a dollar, what if we just raise it to $2? We can make 30 cents on a dollar, right? So that's why in the last 17 years since ACA, double-digit increases have been a standard year over year. It's not because of the utilization. It's because the carriers have sort of created this convoluted mess with the hospital systems to allow hospitals to bill as much as they want to. They give them a sort of artificial network discount. It's like buy two get one free. It's all bullshit, right?
Right.
The price of the can of beans was lower the day before they did the buy two get
Yeah, the
three free or
$500
whatever.
Band-Aid. Yeah.
It's all bullshit. So it's
Right.
smoke and mirrors. So what we decided was, hey, we also know the fact that the PPO networks of Blue Cross, United, Cigna, Aetna, the PPO networks have nothing to do with quality. It's all about reimbursement and money only. So we thought, okay, why is it that these groups that are using AIM care management are having such a lower spend in medical and prescription drugs? Why in the hell is that? It's because people are spending time with the nurse, identifying providers that are evidence-based practitioners. We're not taking people's doctors away. We're not denying people access. We're actually spending more time helping people get the right doctors for the right reason at the right time, at the right place, and at the right price. So really the big answer is this. The only way to solve employer-sponsored healthcare is create a third swim lane. So let me explain. Traditional plans have in-network, they have out-of-network. The new plans have a third swim lane called guided. So to your point, Eric, and I have the pleasure of having this plan with my family too. I choose the guided plan. So what that means is, I'll give you an example. My son had a impacted wisdom tooth, right? It falls under major medical. We called the nurse. The nurse said, there's 4 oral surgeons in Naples, Florida. One, I wouldn't have operated on a goldfish. He has lawsuits, medical malpractice. Every other patient that goes there gets reinfection. It's bad news bears. The second one has only been practicing for about 2 years. I'm not sure about that. Third one doesn't really operate anymore, kind of retired, just moved to a hospital, still could go there, but hospital pricing is going to kill you. And the fourth one is board certified, no lawsuits, 20 years doing it, gets people in and out, knocks out the oral surgeries on these pediatric. It was for my son, so my son was about 17, 18 at the time. So what we said was, okay, if this oral surgeon can take care of my son, get the wisdom tooth in and out, no problem. That means it's a high quality experience. It's going to be a lower cost. So we incentivized the plan incentivized my family by saying, okay, if you go to Dr. Fontana, was the actual name of the doctor, then you pay zero copay, zero deductible, and zero out of pocket.
It's like an HMO in that regard,
Yeah, to some degree, it's like
as far as a
a
cost perspective.
evidence-based steerage. It's not like an HMO is like, well, you got to get permission to go to Doctor A to Doctor B. It's kind of a hassle. People remember it like that. But this is a more clinical. I'll give you one other example. We had a client in Southern Texas that had a big claimant. It was a Blue Cross Blue Shield Texas. It was a Willis case. We got Willis fired and we brought it on to Thompson Risk Venture because of one reason only. They had a controller who had 2 types of cancer. She had a regional cyst that was considered breast cancer, kind of by her collarbone, and she also had liver cancer. And she was seeing a doctor at one of the big name hospitals in Texas that she thought was a legendary facility because of the name, right? And it's one of those big ones. It's on all the airport marquees. It's all over the country. I won't say which, but think of like Mayo, Moffitt, Shands, MD Anderson. It's one of those. Well, just because they spend 54 freaking million dollars a year in marketing doesn't mean their doctors are worth a shit. So we found out that her oncologist that she was using that wasn't reducing the size of the tumor, or the problem, that the cancerous issue she was having on her liver, which is why they couldn't do anything to the breast cancer. So consequentially, we found out that that doctor was a 40 out of 100 in terms of quality score. And we sat down with her with permission of the CEO and her permission, and obviously signed disclosure. And we said, look, the doctor you're seeing probably doesn't know what they're doing. So we'd like to have a peer-to-peer with our medical team. So the doctor accepted the phone call. And this is unbelievable, but this happens every freaking day in American healthcare. It's such a sad state of affairs. We said to the doctor, now, you've diagnosed this patient with these types of cancers, and you're treating her with this type of, cancer treatment. He said, yes. We said, how do you know that that's the cancer that she has? And he said, the answer of the oncologist was, well, I've been doing oncology for 28 years. All I had to do was take one good look at her, and I knew that's the exact cancer that she had. And we went, wait. So Milliman Care Guidelines, otherwise known as MCG, is like the Bible for doctors. And if you go to that book and you go to page, chapter, and verse that says, for this type of cancer, it requires a very precision blood test. Can you believe that that son of a bitch never did the blood test? So we said, in order for it to be covered for her, we need validation that she has this type of cancer. Of course, it made him quite pissed off as a practitioner, but we didn't care because we're protecting the patient. Patient agrees. We set up the blood work. Guess what? It's not the type of cancer. It's not that type of cancer. So we moved her to another oncologist that was a 95 out of 100 in quality score, gave her a different treatment. The liver cancer reduced by 60% in size, making it safe enough for them to remove the cyst near her collarbone. She has now grown all of her hair back. They did a full removal of breast cancer. She's now in remission on breast cancer, and they're still treating her for liver disease. But here's the best part. She has 3 daughters. She's able to go to the freaking soccer practices. She's able to be a mom. She's able to go get her hair done. And quite frankly, her morale, and the morale of the C-suite, knowing that this very important executive at the company was suffering, is amazing. And everybody there is now, call the nurse, I better find out, is this the right doctor? Is this the right doctor? I'll tell you one other one. We had an employee, right? We have 7,700 employees. By the way, our medical and RX spend is 52% below the norm, which is unfreaking believable. We spend probably $35 million a year, maybe a little less, in medical and RX claims. If we were on Buka, we'd be spending like $60 million a year in medical and RX. And obviously the PE guys love that. But look, if this was easy, everybody would be doing it. But it's the stories. Think about how we turn that life around for that lady with cancer. Or my last anecdotal story in that is a daughter of a family in the venture world who was a star softball pitcher in high school, like an amazing pitcher, and she was having a rotator cuff issue. They used a plan that she was on her father's insurance. The mother works with us. Her father's insurance plan was a regular Blue Cross type run-of-the-mill thing. They just chose an orthopedic. They went to it. Doctor operated on her shoulder. She lost 60% of her circular movement permanently. Her career for softball and her dreams of going to college and playing softball were done. So when they came on to our plan at the qualified event, the father decided to not put her on his plan and put her on our plan. And wouldn't you know, we kind of made this suggestion, like, well, why don't you call the nurse and get the advice of another orthopedic and just take a look at the one that you had. So the one that they went to that was a Blue Cross participating orthopedic surgeon was a 20 out of 100 quality, very bad. And when the new orthopedic surgeon that we put on that case, 95 out of 100, looked at it, he said that the orthopedic surgeon that did the surgery was using techniques that were in the 90s, old techniques that the doctor hadn't kept up on, and that the new doctor said he would never have operated on her. He would have treated her different. He could have potentially kept her continuing to play the game. So they ended up doing a new revision rotator cuff surgery on her, and she's able to play like recreationally, not professionally, but her movement is back, but certainly not enough to where she could go back into like a D1, D2 type program. So the bottom line is that you've got to have the guidance of your own counsel when it comes to choosing the right doctor first, because you absolutely cannot trust the system in the way that it's designed. And the results of that for employers is it can be as much as a half cost in terms of healthcare spend. RX prescription drugs is a whole nother ball game, but those are two clear examples, Eric, of like really helping people and being able to deliver healthcare the way that it's really intended.
Right. And the cool thing is that from a choice perspective, like the plan I'm on the same plan you're describing that you developed. This a large self-funded plan through our company. And what I like about it is that I get the Cigna PPO and I can treat it like a PPO if I don't have time or feel like going through the process of getting someone approved. Maybe I've seen this doctor for 15 years and they're part of the network of Cigna at least. I'll just pay my copay and I can go see him like any old PPO. There's obviously the out of network scenarios where you're going to pay a lot more money out of pocket if you do that. I try not to do that. And then when I have time, or now I'm doing it almost like 99% of the time because it's so awesome, is I get on with the AIM nurse program that now we got Venture owns, that company, and it's part of your program that you developed, and get the doctors referred, through their score of who I could see. And maybe I know of a couple of names and I give them those names and they check them. And so, like, my wife wants to see this doctor because so and so saw that doctor before, their friend. So then they check their score. Yep, that's a good one. Go. 100% coverage, right? And you still get your emergency room and see things. And then lastly, I'll just say on the prescription, and you'll talk to this, is that I don't think I've paid a copay for a prescription. I may pay one or two copays per person in my family a year. Otherwise, it's zero. So I'm saving all these copays and out-of-pocket BS that occurs at a doctor's office beyond the copay. I'm saving that by going guided. B, I'm saving on prescriptions. I probably used to spend under the old model, probably another 8 grand or 10 grand on copays, for the whole family, out of pocket.
Yep.
And so, or things aren't covered on this formulary list, things like that. And it seems like whatever you've designed is I'm getting, and there's some crazy stuff some of my daughters are getting sometimes prescribed. That they're getting it covered 100%, not just antibiotics. So I like all these choices I have in one plan and how you reduce the out-of-pocket cost. So I bring this up because in the PNC world, again, we don't want to hear any nasty feedback. What we want as
Yeah.
little feedback as possible. And so why don't you talk about now, using this for a PNC agent to attract or target some of their larger current clients who maybe you're not dealing with the healthcare because you didn't want to deal with it. Talk about the mechanics of it now, of how you set this up now, Dan. Like,
Yeah. Yeah.
how's it work? And how do you mitigate the cost for the owner and ensure
Sure.
huge savings too?
Yeah. So let me make one comment about the drugs, and then I'll give a little bit of color on sort of the engineering of how we put all this together. So for PNC advisors that are listening, sometimes they always say the devil's in the details, right? Or another thing that people say is where there's mystery, there's margin. And that could not be, that is the most spear tip statement when it comes to prescription drugs. So here's sort of the whole center of the treasure map, right? If you look at a PBM contract, think about this. Optum and United Healthcare, same company. Express Scripts, Cigna, same company. Um, Aetna and CVS, Caremark, same company. Now, there's something wrong with that. It's like the fox guarding the hen house. So, when it comes to a traditional Buca plan that has a prescription drug plan attached to it, it's more of a, with all due respect to capitalism, a verticalization business strategy for the carrier. Carrier health insurance carriers don't make money in health insurance anymore. They barely scoot that 15% margin, sometimes even smaller, because of the amount of the inflated the inflationary impact on healthcare costs. It's so hard for them to manage, they barely even make it. So the only way for insurance carriers, and I don't know where a lot of these P&C brokers reside that may be listening, but for instance, Florida, you have health insurance carriers that are now buying urgent cares. United Healthcare owns MedExpress. United Healthcare is the largest employer of primary care doctors in the US. 65,000 primary care doctors work for United Healthcare under a brand called WellMed. Blue Cross Blue Shield is opening clinics. Aetna, right? They have the CVS owns them. CVS Minute Clinics owned by Aetna. United Healthcare also owns MedExpress, but a lot of people didn't know that. So these carriers are verticalizing the consumer's journey in healthcare straight into their pocket. So how do they do it on drugs, and how do we avoid it? Well, if you ever were to get your hands on a copy of a PBM contract, a pharmacy benefit manager contract from a traditional PBM, in the contract, black and white, it says the PBM does not have fiduciary interest to the plan member. They have fiduciary interest to the shareholders. So what that means is if somebody, I mean, you brought it up, but let's just say one of your daughters or you or somebody in my family gets a diagnosis for a particular prescription. It is the job of the PBM to make sure that our families get the highest cost drug related to that type of diagnosis or illness versus going to the lower cost drug for it, because the higher cost drug has more margin for the shareholders of the drug company. Now, when we studied this over the last decade and a half or so, we said, if that's the only thing in the way, which is the enforcement of high margin drugs, is sad, that's the true state of how it works. What if we reverse the order of that? What if we say, under the contract, we're a fiduciary, not the carrier, and we are a fiduciary to the plan member first, not the shareholders of the insurance company. Very different set of circumstances. So now, and you're seeing this, and you're not the only one across the country that said this to me, but like, damn, every time I go to the damn pharmacy, it's zero cost, zero cost. That's because we engineered it so that if someone has a diagnosis and the doctors, look, I used to be a drug rep between Paychex and ADP. I know how to incentivize doctors, and I know how the game's played to get them to write drugs that people don't need, or otherwise write the top brand drugs that have the smallest runway from the patent where they can make the biggest profits, right? That's how drugs work in America. So when a person fills a drug on our plan, the plan goes, okay, wait a minute, this person has diabetes, okay, Trulicity, Jardiance, whatever the prescription drugs, what's the most efficacious, what's the highest efficacy, but what's the least cost? Uh-oh, there's a biosimilar generic on the market for it. It's the same chemicals, same maker, nothing different, nothing that's going to do anything to the person at all clinically except for help them get symptom management or cure. But when they go to the pharmacy, nothing. So, the other trick that carriers do, which we change, and a lot of P&C advisors should know this and be great advice for their clients, is look, did you know that when a copay is paid at a retail pharmacy, somebody asked the question, I always ask questions in Catholic school, that's why I got in trouble, but where does the copay go? Well, if you pay a $10 generic copay at Walgreens, the $10 goes to Walgreens. But if the actual net cost of the drug is $2, Walgreens just made a split of $8 on the $10 copay. So if a consumer walks in and says, hey, instead of processing my insurance, can you just tell me what the cash pay of that drug is? They're not allowed to just openly tell you that you could just pay $2 for it, because if they collect the $10 copay, that's an $8 spread. So what we do is we require our contract to allow no spread pricing at the pharmacy retail level, and we cut out the retailer from spread pricing. So when the retailer facilitates the med at the point of service, if the cost is less than a certain level that we put, maybe it's $10, $15, we make it zero cost. So we pay the net cost of the straight maker, from the straight maker of the drug to the retail distribution, and all that savings passes to the plan members, millions of dollars a year, which is huge. So how do you put it together, right? Well, this is referred to as an unbundled, non-commercial, self-funded plan. In fact, if it makes you nervous, the word self-funded, don't be, because we put protections around it that are fully insured. So we could show any
And then like in the
CFO,
PNC
CEO.
world, it's almost like an unbundled captive product, right? We got the
Yes,
PPA, the fronting carrier, you got your risk management system that's separate, everything's separate. So you can just
it
keep maneuvering parts, right?
yes. Think of it like a paid loss retro work comp, right? Where you have skin in the game a little bit, and if you manage that workers' comp, right, that loss ratio well enough, their score, then they make money back on the plan. So if we put in these tools like evidence-based guidance, outcomes-based, if we put in specialty networks like surgery bundles, contracted doctors that don't take insurance and offer those as well that are high quality, or we put in specialty networks like musculoskeletal doctors who are the best in the country who hate insurance, and we include them in the plan, or we do contractual radiology networks that are nationwide, and we start tapping some of those centers of excellence and add that to the plan and do it so that the HR people don't go crazy or pull their hair out. It's a massive win.
Love it. And so you're saying 50 is the smallest prospective client. What's the good sweet spot though? 100, 200
I'd
employees?
say, 100, 150 enrolled. Yeah. You're
Okay.
gonna, I mean, so we can look, if the advisors on the call want to see a different experience, like completely, get us a census. We have a tool we created called Next Gen AI. So one of the big things that your benefit advisors and your firm are hitting their head against the wall every day on is they can't get data because the fully insured carriers won't give you claims. We figured out a way with our AI team to build a tool that I can get medical and RX claims 10 years on every single employee in a group. All I need is a census. It's de-identified, but our actuaries can actually take that and rate exactly how much that health plan should cost and the prescription drugs. Then we put in the tools that I've been talking about on the call here, and we could figure out how much savings we could curve out of their plan. So just as an example, this 2600 life case that I just did, they were fully insured Cigna. They're going to move to our plan with Guided in January. I reduced, it doesn't happen all the time, $4.5 million of spend.
Whoa.
It's a
And then
huge number.
what's their risk being self-funded?
So if you're straight self-funded, right, you got to have capital and an operating account that has substantial balance to back up any risk of potentially having higher claims than funding. For a middle market company like 100 to 500, we put in a backstop of a fully insured ag policy. All that means is where we're actuarially betting and saying, hey, we need to hold this much money to substantiate this amount of claims coming in. We put a fully insured policy around that. So in the event, it hasn't happened yet, that we're off, and we use have Aon as an actuary, and we have our own in-house legal team on all these plans, which is awesome. But in the event, in this farthest stretch that we didn't put the funding ratio right, if we know what the client is going to expect to spend, well, let's call that 100%. 100% is expected, right? If they're going to spend a dollar, we predict they're going to spend a dollar. That's 100%. Think of it like a loss ratio. We will ask them to spend $1.25. So we're always going to be 25% above our bet. Now, the good news is all those clients are running at about 88, 85 to 88%. So think about that. If they're funding at 125% of expected, they're getting back 45%. And our plans are triggered so that the client earns back 100% of surplus. And the only other sort of like hidden thing, and PNC advisors appreciate this because they're always competing for, brokers out there like bleeding their comp out, but it's not a percentage of commission. We do a PEPM. So usually it's like 35 or $40 PEPM. It doesn't matter if the plan's 60 million or 20 million. And that alone, if you're going after a client or you have the PNC on a client, but you want the benefits on a client to get that other PNC firm out of there who's going to try to bring their benefits person, or their benefits person is trying to bring their PNC person to get you out, get us in because we have BOR protection. No one can broker of record our guided plans. It's not even possible. So think about that. Bring those deals, talk to Eric, and we'll be able to look at something for you. And maybe we do a co-broker deal, but you're protected on the side of being flanked by competition, and you can't lose the business.
No, that's great. Hey everybody, it's Eric. I just want to pop in for a quick announcement. Exciting news. I just launched my new book on Amazon. It's called The Blueprint: An Insurance Agency's Unconventional Rise to the Top. And it goes through a little bit about how I built the agency Insured Solutions since 2009 to today. And the blueprint in terms of how I actually did it with the tech stack, the offshore, nearshore talent, and digital marketing techniques that I use. So pick up a copy today on Amazon. Thanks, guys. So, like as an example, then, so you haven't had so far any groups exceed their funding,
Nope.
125.
No, we've had one that was uh, at the 125, they ran at 71% and they had a $671,000 surplus. And they were like, holy shit, this is crazy. So the CFO there is a good guy. He's a little bit of a pessimist, like some are.
Yeah.
And he shopped us. And even with a -5% on our plan, so we adjusted the working rates down on their renewal, but the competition came in at 20 or 30% above where we were for fully insured rates. And I said, I'm glad you did that because that's an example of why you're doing what you do, because the carriers have rigged the way that prescription drugs and medical claims are paid, just like we've been talking about. So they want to justify higher increases because why? They want to justify a higher margin in the way they make money on the health insurance. And that is the truth. In fact, a couple of people have said to me, be careful because somebody's going to snipe you out. And I'm like, hopefully that doesn't happen in the United States. This is not Latin America, but I wouldn't be surprised if somebody tried because we are saving clients millions upon millions of dollars. And I mean, I'm getting some global directors of HR for large publicly traded companies asking me questions now. And just like this podcast, I just did one for a very famous national HR podcast, and I had the global human resource director and CFO for a very large national company with about 42,000 employees say, we need you to fly out here and we want to talk now. So I'm telling you that even the large brokers don't like what I'm doing, the carriers don't like what I'm doing, and the PBMs don't like what I'm doing. So I won't be hanging out at any conferences with carrier, PBM, or large broker executives anytime soon.
Right. So, and so back, and then for the funding piece, then, like that group you described that was with Cigna already, and then you converted them. So, what was their cash outlay to put in the account compared to what they were paying in their prior premium alone? Like, was it
Yeah.
an increase of cash they had to put aside compared to what they made
No.
before?
No, so what we do is we create the working rates similar to what they're paying a fully insured plan. So there's like the single plus spouse, children, the family rate. So we look at the allocations and we say, okay, this is how much funding is going to come into the account. Here's your fixed cost, here's your variable. It would take 6 catastrophic claims in the first 3 months to not allow them to do it feasibly. So that's almost an impossible number to hit. So we would say, okay, the first 3 months, right? Some portion goes to fixed and the rest of the money is theirs sitting in an account. So this type of plan actually creates a positive cash balance and increases the company's EBITDA and their valuation by doing a health plan like this, because the contrary is like the casino. You're just giving the money to the table and losing every single time with the carriers. You don't get any cash, accumulation balance. But this client funds about $4 million a month. So let's just call it, I don't know, 3.2 is fixed costs, maybe you know, um 1.6 million is claims. So 1.6 sits in the account, 1.6 month 2, 1.6 month 3. And in the transition to these type of plans, it takes a little bit of time for claims to flow in. So by month 3, they have, what is that, 6.2 or $5.2 million sitting in reserve. And that's where claims start coming in and hitting. And that's in essence how they start to really win the game, because they start to see the transparency about claims coming in, drugs being mitigated, people getting better doctors, costs going down, diagnosis getting corrected, people getting off of the wrong cancer treatments, people getting better orthopedic surgeons, people getting a better financial experience. And that's where it all comes together in the end.
Right. So, So then it seems like they were either at or less than what they were paying fully insured going in. They didn't have to set aside another amount of dollars.
Nope.
And then at the end of the day, let's say the end at the renewal period, if there is a, money coming back technically to the client, can they then lower their, premiums to a little bit to the employee and
Yeah.
themselves?
Yeah. So like for venture, we've done this 4 years. We've had 0% increases for 4 years. What we do is we look at the reserve balance, and as opposed to say lowering premiums, we start to cover more stuff. So an example is we have a lot of females in a particular demographic and ethnicity that have some challenges with obesity and diabetes, right? So what we did was we decided to start covering things that typically aren't covered in a plan, like breast reconstruction, or if a woman has a severity with obesity and they do a weight reduction surgery, we actually will pay the cosmetic reconstruction for their breasts. And I know this is like a crazy thing. I'm talking about breasts on here, and you told me to bring up breasts, so I decided to do it. Um,
I
but
was talking about chicken, but yeah, go ahead.
oh, okay, go turkey breast or whatever. No,
Yeah.
but the main point is like, look, if you can help your people by hitting where the source hurts the worst, the health insurance companies won't pay for that types of extended treatment. But what does it do to the morale of a woman who's, going through a midlife crisis with menopause? She's overweight, right? She's had a lot of children. She tries to get on Ozempic and that works out and she loses all this weight and she's carrying around these horrible heavy breasts that she can't do anything with. Health insurance isn't going to do shit, and a middle income person can't pay for cosmetic reduction. So when we look at the incidences of claims on our plan, we go, okay, what are the problems, right? We know the root problems, we know where the big claims are, and that was standing out as a problem. So we decided, you know what, we're going to start offering that treatment. We also offer Regenix. So it's a fact that 58% of musculoskeletal surgery in the US is unnecessary. It's because a lot of orthopedic surgeons drive Bentleys, right? It's an incentive for them to cut. So we say, hey, look, let's help the patient first. Say, hey, how about stem cell therapy or regenerative medicine for your joints, so that you don't have to have a joint replacement, because your joints are a lot like starfish, right? Even though you stress out your joint, don't get me wrong, there are irreparable situations. Like when someone has end stage degenerative hip disorder, we're not saying, hey, by the way, can we just inject some stuff in there and help you? Fuck no, it's bone to bone. So there's nothing better than just surgery. So that's the high quality doctor, get them in, get them out, high quality, low price, and that's huge. But what we do, if someone has a stressed out knee, like a young child, like one of my boys, say, so they blow a knee out on a soccer field, if an orthopedic surgeon looks at it, 9 out of 10 in America are going to say, let's go cut. But if the high quality ones that we have look at it, they go, well, there's two ways here. One is we could do surgery, but let's try Regenix. So Venture pays for Regenix for everyone for musculoskeletal. We've had 3 people successfully do it, where with some a little bit longer term treatments, the stem cell approach to regenerative medicine allows the tendons and the muscular structure of the knee to actually improve itself naturally, and it creates a much stronger joint than if somebody went in there with pins and screws and artificial stuff like a blocks and all the other things that they do. So that's the kind of stuff, like when we see that we're actually fixing healthcare and people are experiencing it in the most amazing way and the high quality, low cost, then we start to add other things. So it only gets better and better over
And
time.
I love the fact you said like the renewal process is usually has experience can't guarantee it, but has been either no increase or maybe a decrease.
Right.
And so what's been the reaction of clients then at renewal time as far as the treatment of the broker who brought that in or you or your team? Like what do they say? Like they've been probably experiencing these huge increases, right? And now you're coming in and leveling it out.
Yeah. I mean, it's a lot of times the CEOs will jump in and they'll say, well, shit, I was expecting a 20% increase and lowered to a 10. You just told me that we got zero. And I have an ambulance company in a state in the Northeast that has about 400 employees enrolled. They just finished their renewal cycle. It was 470,000 in surplus. So they said, well, what do you expect? Should we keep the 471 in for next year's anticipated claims, or what should we do? We never say wipe out the balance account. Never want to totally reduce reserves, because that's a really good way. Like anybody that's on this call, they're all insurance people, so we all know, like, if you don't take an umbrella, it's going to pour rain. That's just our risk mentality that we have. Not regular human beings can't think that way, but we can as insurance executive people. But in the case of this, we say, all right, keep in 250 grand, but you know what? Take out 200 grand. So in this case, they actually were saving jobs and they bought a new ambulance. So they used the 200K to put a down payment on like a super technology sophisticated ambulance, one that's better than their normal fleet. So here they are, like, buying more capital, making capital improvements, saving jobs, because the healthcare is the third largest expense on their balance sheet. And we have had success where we turn the health plan from an expense side of the balance sheet over to an asset. So the health plan actually turns into cash flow. So it's hard for people to believe and stomach it, but you get the right person in front of us and we can get in front of them and really learn where the mistakes are being made in their health plan and their prescription drugs. The amount of money that's just, I mean, look, my last comment would this. Warren Buffett said healthcare in the United States is a $4 trillion tapeworm. We believe that there's $1 trillion in fraud, waste, and abuse in healthcare in the United States. And could you imagine what that would look like if you reduce the deficit by $1 trillion? Like, that's insane. So,
Exactly. Now, hey, and then Dan, let me ask you, because I'm not knowledgeable enough on this, but let's say a client already has a self-insured plan as well, like they're large.
yep.
What do they typically like? You don't need to get too far in the weeds here, but like in a sentence or two, like what do they currently have compared to what you're about to bring in
Yeah.
to mitigate?
So for us, what we're able to do is look at their claims. It becomes very plainly obvious. Like, what are the percentage of Medicare that they're paying to hospitals? What are they paying for outpatient surgeries? What are they paying for prescriptions? What are they paying for musculoskeletal surgeries? What's the rate of diagnosis? What's the rate of disease? How many people are having reinfections? And when you see that, I mean, just one alone, and it will blow the minds of CFOs. How many pregnancies or deliveries in a client were C-sections versus natural born babies? And I'm willing to challenge anyone that's listening. I bet you that the rate of C-sections in most of the groups that are self-funded but not doing plans like we are, that's 75%. And it's not a surprise. It's because GYNs, OBGYNs force the C-sections because A, it's higher revenue for the hospital. B, it protects them because they're scared of natural deliveries and malpractice. But a C-section is 50,000 plus versus a natural delivery at 7. So that's a hospital game. I just went through having our fourth grandchild, and I'm already in a big fight with the hospital because they charged for something called skin to skin, where they laid my grandson on my daughter's chest and they charged for that shit. And then they charged a fee for what they call a delayed umbilical cord cut. They took the baby out, still had the cord in, and the doctor said, well, let's just give it a few minutes to let the baby still get more nutrients from the placenta, what I thought was bullshit. And they waited like 15 minutes, then they cut it, and they charged us for a delayed umbilical cord cut. And then they charged my daughter twice for baby seat advice. Like, so bringing the baby out and putting it in the car seat. She's like, this is my second son. What the hell? And it was $1,000 for putting a baby in a fucking car seat. So I'm having the hospital reduce the charges. It's all mind-boggling, man. It's just,
But you're saying that the standard plans are have that sort of arrangement
yeah,
versus and they don't get and there's no nurse case manager piece like
nope.
in there, I assume.
Nobody's looking at it. Nobody has maternity management. Nobody has an independent advisor overwatching that entire maternity process. It's just the hospital
So they're just
pillaging.
piecing the products together of a network and a pharmacy benefits
Correct.
piece, nothing in between to help mitigate. Well, I guess there's a
Nope.
claim, TPA, but like they're just processing claims and
That's
checks,
it.
right? Okay.
That's
Paying
it.
people. And there's no review. There's like most of these
Nope.
self-fundeds aren't having this sort of,
Nope.
okay.
Just a clearinghouse. They're allowing pre-certs and prior auths to just go through as fast as they possibly can. It's so scary.
Interesting. All right. And again, so the neat thing about the way you designed it is that the doctors and hospitals take the insurance because it's part of, even if you're going guided or you use the PPO, it's still a Cigna plan. And on
Right.
the card, you even have a Cigna PPO logo and things
Yep.
to make it so that the doctors can easily send their claim information and hospitals to Cigna with this address for the processing and as well. So I like that because if you don't have that sort of brand on it, it's hard to get the doctors and hospitals to participate easily, and it causes a lot of backlash. So that was a huge thing. And then the last thing I'll say, I noticed that like I had to get an MRI on my shoulder, like a slight tear in a rotator cuff. And I used the network, the green imaging network,
Yeah.
and I went guided with it. And so I got my MRI at 100% coverage. It was the same, it was exact facility that my orthopedist that was wanting me to go to. And then I just had a friend that just had to have it, and she's on a Blue Cross plan. She's a teacher. I told her the concept about, at least try to get cash pay versus your deductible, and she did
Yeah.
that and got it for like, $800 instead of $2,500 because she said
Oh,
I'll pay
wow.
cash. And I told her how you had done what you had done with me and our plan. So anyway, it's a great experience. And so I think that bleeds back up to the client. And now you're, as a P&C agent, bringing this in, a huge hero. You don't have to worry as much about getting beat up. And then you earn commission on this too. And then your team does really all the heavy lifting, the enrolling, the whole thing. And if they have a benefits team, if their shop as a P&C agent, you guys will work with them too, right?
Oh, yeah. Yeah. Look, I mean, is it perfect? No. Is the regular plans perfect? No. And when there is noise on these plans, there's nothing HR can do about it because the CFO and CEO are like, we're saving hundreds of thousands of dollars. We can't move the plan. So we just like your agencies would do when you have a service issue that's escalated, right? We'll jump a team in there and, provide some paperwork instruction if it's a doctor's office that has never seen the plan before, or like if there's little things that happen. But you are right, Eric. Americans have Stockholm syndrome with insurance companies. They love their abuser and they just they don't understand what the new is. So we will lease a carrier. We can use United, Blue Cross, Cigna. We've got some permission with Aetna on certain size clients where we could use their Coliseum. We could use their network. However, we have the right to go in and say, no, 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 no. Even though this doctor's a PPO doc, I wouldn't even send a goldfish to him. Or you don't want to go to Dr. Hack him up. He's got really bad ratings. So we could make sure that the employees see the brand, they're comfortable. HR cares about two things, people and process. CFO looks at P&L. So we can reduce the cost, but give the member a really great experience, just like you're describing. And I really appreciate the opportunity to talk about these with you because I would love to see some of our PNC, broker advisor partners help them by bringing those clients something really amazing.
P&C agents, have you run into Byberg, which is a Berkshire Hathaway company quoting workers' comp for either your prospects or clients? Well, great news. Insured Solutions, a national MGA, has an appointment that is set up to allow you to quote, bind, and service Byberg at your agency. And the coverage is in all states. It's A-rated. Startups are even accepted. There's 125,000 maximum premium. And some of the tough industries they write are construction, transportation, that includes towing and parcel delivery, manufacturing, security guards that are armed and unarmed, motor mediation, and many more. So go to our website at insuredsolutions.net, click the Get Appointed link. We'll get you logins for you and your team and can set up a webinar for training if you'd like. Also, feel free to email info@insuredsolutions.net and I can handle the submission myself, or call 770-402-5343. Be glad to speak to you and give you more detail. Thanks. Absolutely. So if people had questions, Dan, how do they get in touch with you? What's the easiest way if they had questions?
You know what I would suggest for those watching, connect with me on LinkedIn. LinkedIn, I'm Dan Tom. You can search Dan Thompson Employee Benefits. I've had that for forever. Just Dan Thompson. I'm in Naples, Florida most of the year, but that's what my moniker is on LinkedIn. So it's pretty easy to see me. Guy with glasses and a funky beard. I got a pretty big network of about 9,000 or so brokers, advisors, and CFOs, and we do a lot of posts. So you could repost my content. You can take my content off. Last thing I'll say is we have a documentary coming out pretty soon. We did a first one on medical. We're doing the second one on prescription drugs, and it has had like tens of thousands of views. I think that it'll end up getting even bigger and more viral, but it's opening up the truth like nobody's ever done before. And a lot of companies are now coming to us and saying, "Hey, we need you to help us change."
And where can you access those documentaries? YouTube or?
So we have on my LinkedIn, there's the teaser and a trailer and the full documentary. It's personal, it's not healthcare is the first one. And then the second one is called Side Effects May Include. And it's not just me, it's about maybe 50 brokers that are doing these types of plans. We all chipped in and we hired a professional Hollywood director and we made it. And the films include PBMs, clients, hospitals, patients, doctors. I mean, you wouldn't believe how well done it is, but it's literally Hollywood level. They'll be on Netflix, but Side Effects May Include will be out within the next few months, and that's a huge
Great,
one.
man. Congrats on getting that done. That's really cool.
Yeah,
And then as brokers, if you have questions and you want to submit a case, you can also come through me, info@insuredsolutions.net, info@insuredsolutions.net, and my cell number is 770-402-5343. And I'll get Dan, I'll set the appointment with Dan for you. And I'll be
awesome.
on because I want to continue to learn about it as well. But Dan, I appreciate the time, man. This has been great.
My
And
pleasure.
looking forward to seeing you soon as well.
Likewise, and just take care and looking forward to seeing more of those opportunities where we can help you and your family, just like mine, have zero costs for healthcare. That's the best outcome we could ever think of.
Oh, yeah, I love it, man. Appreciate it. Thanks.
Appreciate it, brother. Have a good one.
Thanks again for tuning in to Insurance Shop Talk. If you enjoyed our deep dive into the latest trends, please don't forget to like, subscribe, and hit the notification bell so you never miss an episode. Until next time, I'm Eric Stein, and this has been Insurance Shop Talk.